evening. We start tonight with the Reserve Bank's decision to keep interest rates at their current level of 8.25%. But a warning today that upside risks to the inflation outlook remain. In other words, inflation is still high. The Reserve Bank Governor, Tertia Jacobs, saying that they are ready to act if inflation risks do materialize.
3 members of the committee preferred to keep rates on hold, and 2 preferred an increase of 25 basis points. At the current repurchase rate level, policy is restrictive, consistent with the inflation outlook and elevated inflation expectations. Serious upside risks to the inflation outlook remain. In light of these risks, the committee remains vigilant and stands ready to act should risks begin to materialize.
Tertia Jacobs is a Treasury economist at Investec. Tertia, good afternoon to you, and thank you for your time on the pulse tonight. To see that 2 out of the 5 members of the Monetary Policy Committee wanted a hike, does that come as a surprise to you?
Stephen, where I stand, yes, a little bit, because I thought there would perhaps be acknowledgement of inflation that is moderated. But the governor stressed that there's serious upside risks to inflation, and I think that is where the 2 members came in.
It's interesting to see how sticky inflation has been. How big a factor is fuel prices in all of this at the moment?
I think that is one of the wild cards. You know, in the beginning of the year, one of the risks to inflation or to the disinflation process was the potential increase in energy prices, especially the oil price. And that is now materialized. So although, you know, it's very unlikely that we will go back to inflation, you know, above 6%, it does arrest this return of inflation to 4.5%. And we do see inflation then re-accelerating to about 5.4, 5.5% on the back of the increase in the fuel and the diesel prices.
Food price inflation is still so high, Tertia, and I mean there are various reasons for that. Fuel plays a role in that, but also, of course, what's happening with Russia and Ukraine at the moment. I mean, that must also be keeping some members of the Monetary Policy Committee awake at night.
I think so. So the disinflationary trend in food prices is likely to continue. So in coming months, the year-on-year rate of increase would subside, but it doesn't mean that, you know, actual food prices will be lower. And then there are risks out there. So the one is the increase in transport costs because of the increase in the diesel price. And then we're still waiting to assess the effect of the intensity of El Nino that will be playing out in coming months. But what we do understand is that parts of the country will continue to have good rainfalls. So perhaps the effect will be more modest than in 2017 and 2018.
Still huge conversations around load shedding, and the governor reiterating again on behalf of the Monetary Policy Committee what an impact this has. So load shedding and logistics, I suppose he really means Transnet. The ANC saying in the last hour or so they believe load shedding, intense load shedding, will end soon. Look, Tertia, I mean, we've been told that before. But what impact is that having at the moment?
You know, Stephen, I think that is sort of an underlying dynamic that is going to be with us for some time. We have seen the impact of load shedding on companies' input costs in the context of they have to use more diesel to run generators, more investment into renewable energy. So that is taking away investment that could have gone into opening new shopping malls. So it's just actually keeping the current productive capacity of the economy as is. So it's not generating new growth per se. So we're all waiting now to see how the return of the Kasidi 3 and 4 units into the 4th quarter will play out, because that will hopefully provide some relief and at times, you know, would be able to reduce load shedding by 3%. But I think there are still risks involved because, you know, a lot of the coal power stations still need maintenance. So there could still be a lot of volatility attached to the outlook for load shedding.
The Reserve Bank governor also, perhaps bravely, suggesting that one of the big issues that we need is lower public sector wage growth. In other words, he's talking about the salaries that are paid to government workers, and he says that if those were sort of kept in check to an extent, well, then inflation targeting would work much better, and in fact, this would have a big impact on inflation. I know there's sort of politics, of course. This is consumed by politics. But is he right on an economics basis as well?
You see, what was interesting about this MPC conversation as well, and what came through in the question and answer session, was the focus on fiscal policy. So we know that the fiscal risk has actually increased because there's going to be a substantial revenue shortfall because of the weak growth, especially on corporate income tax, right? So the budget deficit is going to widen. So that basically means that government could potentially issue more bonds, and we need foreign participation. So that has an impact on the country risk premium, because for government to issue bonds at the moment is, especially longer dated bonds, is very expensive. So if there could be an increase in confidence in terms of South Africa's growth prospects, we will be able to attract more foreign capital inflows to buy our government debt. But if that doesn't happen, and that feeds right into the policy rate of the government, the country risk premium increases. So that then feeds into government's revenue, which is declining on the one side, and then the expenditure side on the other side. And no one really wants salary cuts, but when you look at it as a whole, we need expenditure curtailment. So that's the big challenge for South Africa. We either need faster growth or we need more expenditure cuts.
Tertia Jacobs, thank you, Treasury economist at Investec. Really do appreciate the time on the pulse tonight.